Is the stock market in a bubble? Will it continue climbing higher? Or is the crash coming soon? So while some famous investors like Michael Burry believe this is the biggest bubble of all time, other investors such as Cathie Wood have been vocal in saying that we are not in a bubble and that stocks will continue climbing higher. However, there is one key factor which could determine whether we are in a bubble or not, and that is inflation. So in this video, we're going to hear Cathie Wood's updated thoughts on the market today. And she's going to explain why, looking at the latest data on inflation, we should be investing our money in one particular area of the stock market. Okay, so let's get straight into it. I'm not going to make you wait. Instead, let's jump straight into this first clip.
Looking out over the next few years, how important will the rise of the retail investor be and how and where the market goes from day to day?
Yeah, I'm going to give a shout out to Tom Lee from Fundstrat. He picked up on a study that Stan Salviksen, who was the chief strategist of Merrill Lynch in the 80s, when I was just coming of age in this market, Stan had a hypothesis that the baby boomers would make for 15 to 20 years of a bull market in equities. And that's what happened. It was a very simple assumption, and it played out beautifully. Tom Lee, I don't even think he referenced that study, but has taken the notion that millennials are the reason we're in a bull market for equities, and that this leg of the bull market won't end until 2026. And I think he thinks that the bull market, with some fits and starts after that, could actually extend to 2038, I believe it is, which is the year that the number of millennials peak. So this is the echo of the baby boom. I lived through the baby boom years and that equity market move. It was magnificent. It was a very simple assumption, and it worked. And I do feel we are in the same place now.
Cathie, too, lastly, before I let you go, just given everything you've achieved in financial services, the following you do have, how do you feel when you hear there are people or short sellers betting against your funds?
Well, what I think two things. That's what makes a market. And, we're all going to have different points of view based on our own research. So I like the fact that, markets are being made around this controversy. And we want the controversy to be out there. What I found for years is innovation was avoided. And whether it was research or investing, there was less and less of it as our markets moved into more benchmark sensitive territories after the tech and telecom bust and then the 08-09 meltdown. So much so that analysts and portfolio managers felt they were taking a huge risk investing in a stock that was not in an index. Well, guess what? A lot of innovation, which is all about the future, is not captured by indices. In fact, very little of it, we believe, is captured by the indices. And so I felt starting a business on that premise to focus exclusively on disruptive innovation would become productive. And it has, because we have never been in a period ever in history where we've had 5 major innovation platforms involving 14 different technologies, all moving into S-curves, the S-curves feeding one another. We're in a period of explosive innovation. And so, I think that as more and more investors and analysts do the research that we're doing, and we give our research away, we're happy for anyone.
I'm a subscriber. I've signed up.
There you go. There you go. So thank you very much, Brian. But we feel one of our missions and values is to educate, because we feel like there's been a dearth of education in the financial markets around innovation because of this backwards looking, benchmark sensitive style that evolved out of 2 crashes. So many people ask me, are we in a bubble? we couldn't be further from it. I do not believe that investors, the average investor, shall I say, understands how provocative these next 5 to 15 years are going to be as these S curves feed one another and enter exponential growth trajectories that we have never seen before. What's the fixed income market telling us? Fixed income market's not worried about inflation. And we've gotten some pretty heady numbers on inflation because of these supply chain problems and so forth. But the fixed income markets are not worried about inflation. And they're not worried about credit problems brewing out there. That's what we think will change. If we're right, and we think the auto sector will be one of the first places that will see this. If we are right, then the spread between treasuries and auto yields is probably going to start widening. That would be another clue that we are correct. Commodity markets, what are they suggesting? Well, the CRB, the Commodity Research Bureau Index, so it's a broad-based index, but heavily weighted to energy, is starting to tip over. Lumber prices, since the last time I did this video, are down even more. They peaked at 1711 on whatever the metric is. They're down to roughly $500. They got as low as 426, I believe, recently. Copper prices are down from 490. I think we're at 440 now. And we're also seeing some early signs, even in the chip space, that there might be some excesses developing there. So Frank Downing, one of our fintech analysts, he's an Ether miner. He watches NVIDIA's RTX 3070 chip. It's a gaming chip very closely in terms of pricing to gauge what's going on in both the gaming world, but also the world of Ethereum. And he mentioned that prices there peaked out at $1,421 in May. They dropped to $1,065 in July. They popped in August in tandem with crypto prices, so but are still below that peak. And the manufacturer suggested retail price for that chip is $500. So still elevated there, but a change in a price signal potentially. We also noted with interest that NXP's CEO and CFO sold some of their shares not on plan. So this was a deliberate sell. Did they see something? They're very heavily weighted to autos. Do they see something out there in the auto world from a chip point of view that is changing? My guess is they do. The dollar has been stronger than I think a lot of people expected. That would be consistent with commodity prices coming down and inflation risks going down as well.
So Cathie makes some great points in these clips. In particular, I'm really interested by the conversation surrounding inflation. I've talked about this numerous times over the past few months, but I'll do a quick recap for those who may have missed it. So if inflation does begin to rise too quickly, the Fed will have to intervene. Now, one of the ways they'll be able to do so is to raise interest rates. When they do that, the way that we value companies will also change because we'll have to begin using different discount rates. Now, this is going to affect the value of every single company in the stock market. However, the companies that it hits the hardest are those with promising future potential, but today, high PE ratios. So in other words, if inflation comes too quickly, it's the portfolios like Cathie Wood's with ARK which will suffer the most. That's why, in my opinion, rising inflation is not only the single greatest risk for the stock market today as a whole, it's a particularly big threat for Cathie Wood and ARK. Now, if we take a look at the data for inflation, we can see that the latest figures in the USA show us an inflation rate of 5.4% based on the previous 12 months. 5.4%. That is some way above the Fed's average target of just 2%. However, we do have to remember that some of this is transitory, as many prices were actually falling 12 months ago, so we would expect a large rise since then. Now, on a month-by-month basis, we can see that inflation began rising relatively quickly in March of this year. However, the rate of increase has since begun to tail off. And importantly, Cathie shared some key data with us. The fixed income market or the bond markets are indicating that they are not so worried about inflation. Commodity markets are generally coming down, another indicator that inflation isn't such a concern. And the dollar has strengthened in recent months, also indicating that high inflation is less likely. So for me, we can sit here and debate all day long about what will happen with inflation, but the most accurate predictions are usually made in the markets. So the fact that the markets are not as worried about inflation is a very positive indication for us and lends weight to Cathie's thoughts that the stock market today is not in a bubble. But I'm interested to know what you think. Do you agree with Cathie or do you disagree? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.